July 30th, 2023. The wheels stopped at Yellow. After 99 years, the carrier filed for bankruptcy protection. Assets frozen. Shippers stunned. Overnight, 30,000 jobs vanished. Drivers, dock workers, dispatch. This was the largest collapse in U.S. trucking history. Terminals across the country went dark, gates chained, docks idle, freight stranded. So what happened? How does a 99-year icon fail? Bad timing, massive debt, and a fatal standoff pushed Yellow to the brink and over it. In the next minutes, we'll break down what went wrong and what it means for the freight economy. Let's break it down. In 1924, A.J. Harrell pivoted from buses to freight. Yellow Transit Freight Lines was born. The play was simple: move goods faster between cities as commerce exploded across America. Yellow specialized in less-than-truckload, LTL, consolidating many small shipments into one trailer, moving through a web of terminals, then breaking them out for final delivery. Density made it work. Many shippers, one trailer, terminals in, terminals out. By the 1970s, Yellow's terminal map stitched the country together, freight flowing coast to coast, right on time. Coast to coast, city to city. It was a union shop. Teamsters contracts, middle-class wages, benefits, and pensions that built stable lives in trucking towns. Yellow had momentum, but the industry was about to shift beneath its wheels. The trouble starts long before the collapse, with rules that rewrote the road. In 1980, the Motor Carrier Act deregulated trucking. New, lean, often non-union carriers sprang up and undercut legacy costs. Names like FedEx Freight and Old Dominion grew fast on lower labor costs and flexible networks. Yellow fought back by buying scale. 2003, it acquired Roadway for $1.1 billion. 2 years later, USF for $1.5 billion. Bigger, on paper. But debt piled up, and synergies lagged. The bill came due. Terminals overlapped, systems conflicted. Too big, too complex, too slow to integrate. Then 2008 hit. Freight volumes plunged overnight. Debt stayed. Revenue didn't. Cash burned. Survival required Teamsters concessions, wage and pension givebacks to keep the lights on. After 2010, the company looked alive but wasn't healthy. What analysts call a zombie, covering interest but rarely touching principal. Year after year, cash flow limped along, squeezed by debt service, aging equipment, and thin margins. The balance sheets told a story of survival, not strength. Then came 2020. As the pandemic froze demand and disrupted logistics, the firm argued it was essential, moving military freight and critical cargo that couldn't stop. Liquidity vanished. Obligations did not. Under the CARES Act, a $700 million loan arrived. Structured with oversight and conditions, paired with an equity kicker that gave the U.S. roughly a 30% stake. The rationale: preserve capacity, protect national security shipments, prevent a critical link from breaking. Critics called it what it looked like: a bailout for a failing firm. Supporters countered that the alternative, lost capacity and stalled defense moves, was riskier. The structure wasn't free. Taxpayers took upside via equity, and auditors watched the spend. But the bet was clear: cash now, stability later. New money brought new iron. The fleet refreshed. Tractors, trailers, shop upgrades. On the yard, equipment gleamed. On the ledger, depreciation lines turned green. The optics were better. The operations were not yet cheaper. Fuel, maintenance, insurance, and labor, costs that never blinked, kept climbing. Even with a modernized fleet, the operating reality stayed unforgiving. Cash infusion met cost inflation, green versus red in real time. In the end, the loan bought time, nothing more. A partial fix for a structural problem. With red expenses chasing green support, the path forward demanded more than funding. It required a different strategy entirely. Yellow's One Yellow plan would merge regional networks into a single system and change work rules, so some road drivers also worked the docks. Teamsters President Sean O'Brien said no. After years of concessions, members had sacrificed enough and wouldn't accept scope of work changes. By summer 2023, talks hit a wall. Unpaid health and pension contributions triggered a strike threat and a hard deadline. Shippers panicked. Within days, shipment volume plunged about 80% as customers fled. Terminals went dark, trailers stacked, trucks parked, freight stranded across the network. The company collapsed. Bankruptcy followed for a century-old carrier. A plan that needed cooperation met a hard red line, and the market finished the job in days. On August 6, 2023, the giant finally blinked. Chapter 11. The filing didn't just mark a bad quarter. It marked the end of an era built on speed, scale, and swagger. In black ink on a courthouse docket, you could read the weight of 2 decades' decisions, coming due all at once. What killed the giant? Start with unmanageable debt. Early 2000s acquisitions stacked balance sheet weight like pallets on a weak axle. Cheap money hid the strain. Rising rates exposed it. Interest, fees, covenants. Every mile got heavier until momentum turned into drag. Then, inefficiency. 20 years of bolt-ons that never truly bolted on. Mismatched systems, overlapping terminals, duplicate roles. The network looked big on a map, but it bled time at every handoff. Scale without integration isn't strength. It's friction. And the labor breakdown. When trust collapses with the union, service unravels. Freight hesitates, customers defect, cash flow thins. Headlines pile up, and suddenly even prime real estate is tested at auction. By the end, the land was worth more than the enterprise. Cross docks, yards, warehouses, assets with clean addresses and clean exits. When your real estate appraises higher than your operating future, the market hands you your answer. The lesson is simple, and it's brutal. If you can't manage your weight, debt, complexity, labor risk, the road ends. Not with a blowout, but with a slow fade to shoulder. For the next operator, the mandate is clear: run lighter, integrate faster, earn trust every mile. This isn't just one bad season. It's the shock of global demand, trade routes, and policy shifts colliding with U.S. fields. Predictability has given way to volatility, and profits to razor-thin margins. Look at soy. China's long pivot to cheaper record-sized Brazilian harvests siphons U.S. market share. Prices hold better than corn, but pressure is structural, not temporary. Corn isn't immune. Brazil and Argentina keep scaling up. Lower costs, better logistics, aggressive sales. The U.S. edge narrows a little more each year. When margins vanish, the whole supply chain feels it. Big iron sits idle. Purchases are delayed. Rural manufacturing and service jobs absorb the blow. Support dollars kept many afloat in 2025, but they're a bridge, not a cure. The next safety net arrives late. In the end, one era gives way to the next.